Start. Okay, so the chapter 10 problem is a flexible budget performance report. And you're going to have to set it up similar to what I've set it up here. So the thing that I do know is that there's two different setups you may be given. You may be given the information like this problem. So this is exercise 1026A, or you could be given the information for the master budget and the actual in an income statement. So practice some of the problems that below in the different formats so you're familiar with it. But the variance analysis and everything else is similar, or is basically the same approach. It's just that the information that you're given is in a slightly different format. So Main Street Muffins sells muffins to restaurants and coffee houses for an average selling price of $26 per case. So that $26 per case is the selling price per unit. The following information relates to the budget for Main Street Muffins for this year. All figures are annual totals unless otherwise noted. Budgeted sales and case, and then we have some packaging costs and shipping costs per case. Sales commissions, salary expense, office rent, etc. This is all budgeted information. So this is essentially like their formulas that they're using for budgeting purposes. During the year, Main Street Muffins actually sold 9,500 cases, resulting in total sales revenue of $255,200. Actual expenses in total from this year are as follows. So notice we have the same types of expenses given, but they're given to us not in a per unit basis, but in a total. First thing that you need to do is plug in the information that we know into our performance report. So we have 3 different columns with data and then 2 columns that we're going to have our variances in. The column that's the closest to the words, the furthest to the left, column 1, is our actual information. So what actually happened during this year. So actual revenue and actual expenses, and then calculating actual operating income. Column 2, we have to calculate because we need to calculate our flexible budget based on the budget formulas given. And column 3, we also have to calculate based on the budget formulas given. So for the actual, this is pretty easy to just populate in because it's just given to us like this. They actually sold 9,500 cases. So that's our Q. And then our actual revenue was $255,200. And packaging expense was $10,600. Shipping expense was $19,500. Sales commissions $12,760. And you need to calculate the contribution margin. So I'll have a little calculation off to the side. Sales minus total variable expenses. So in this case, we have 3 equals our contribution margin. For this problem, double check all of the numbers as you're going through it, just to make sure you're using the correct numbers, and then any numbers you calculated, just double check them. Because an error in calculation can mess up several answers. How much did you calculate in total variable expenses?
$42,860.
Correct. 42,860. So 255,200 in revenue minus total variable expenses of 42,860 gives you a contribution margin of how much?
212,340.
Correct. 212,340. After contribution margin, we subtract all of our fixed expenses. So we've already used packaging costs, shipping expense, and then sales commission expense. All of those are variable in nature, either based on the sales price, percentage of sales price, or per case, so per unit. The fixed expenses are given. 7,300 was actually incurred. 3,900 rent, depreciation of 2,500. And I realized I forgot one word, sorry. I forgot supplies expense, sorry. For insurance expense, 1,600. And then the last one was office supplies of 1,600. I'm checking them off because I'm not going to use them again. Once you use those, you're not using them again for the actual information. And it does not have you include total expenses. All it's having you do is calculate operating income. So take your contribution margin of 212,340 minus your fixed expenses to get your operating income. So you have to total up your fixed expenses. $16,900 in fixed expenses. And how much was their actual operating income for the year?
195,440.
195,440, correct. I'm using a different color for those for contribution margin and then operating income because those are two numbers in that column that you had to calculate. In this particular case, since they didn't give you the master budget in the income statement format, they just gave you the formulas, you can create the flexible budget first or the master budget first. It doesn't matter which one you choose. The thing that we need to remember is that the flexible budget is based on what quantity?
The same as the actual.
Correct. So the flexible budget is based on actual output, 9,500 cases, because you're trying to figure out how much in revenue you should have earned and how much in expenses and operating income you should have incurred during the period based on actual number of output or actual number of cases in this case that you sold. The master budget column is based on what level?
The budgeted amount.
Yeah. So 9,100 units or cases was what we planned for. So I'll just do this. I'll write a little thing out here. Do you guys want to do the calculations on your own and then check back?
Yeah.
Okay. So go through and I want you to do the flexible budget and then the master budget. And I'm just going to. How much revenue were we planning for?
236,600.
236,600, correct. The numbers that you're more likely to write down incorrectly are the ones that have like the 600, not a 0, not a pretty round number. So just double check all of those that you write it out correctly. For packaging expense, what did you calculate for the flexible budget?
9,500.
$9,500. And for the master budget, you calculated
9,100.
9,100. Shipping expense,
For flex, 19,000.
correct, 19,000 for the flexible budget, and then 18,200 for the master budget, the plan.
Yes.
I didn't put sales commissions yet because it is a slightly different calculation. Sales commissions could be based on a dollar amount per unit sold, or it could be a percentage of total sales. In this particular case, sales commission is 5% of the sales price. So you can do the calculation of taking 5% of $26 per unit and then multiplying that times the number of cases. That's one way. The easier way is just to have the total sales revenue for each level and multiply it times the 5%. So for sales commissions, for the flexible budget, it's 247,000 in sales, total sales, times 0.05 or 5%. For the master budget, it's 236,600 times 5%. How much in sales commissions did you calculate for the flexible budget?
120.
12,000.
12,350.
12,350, correct. And for the master budget,
11,830.
11,830, correct. Okay. Did you guys get all those? Did they make sense?
Yeah.
Okay. I should have done them in the other color. Sorry. Those were all calculated. For contribution margin, you took sales of 247. This is for the flexible budget minus variable expenses of what? How much in total variable expenses did you have for the flexible budget?
40,850.
Too high for that.
For
Oh,
the,
sorry. Yes,
sorry.
40,850. Yes, sorry. I was looking at the fixed expenses. And your CM that you calculated?
206, 150.
Correct. For the master budget,
It's total expense, the variable expense 39,130.
39,130, yep. And we're subtracting the variable expenses from 236 in sales expected to get your contribution margin of 197, 470.
Yeah.
I'm going slow through these because if you make a mistake in the calculation of any of these columns, then it impacts several of your answers.
Yeah.
For the flexible budget, you're subtracting fixed expenses of 15,600 from my contribution margin to calculate operating income of what?
181,870.
In the master budget, that's right. But for the flexible budget, it's 190,
190, 550.
550. In the master budget, you're subtracting
But the same amount as
the
well.
same amount, yep. 15,600 because fixed expenses don't change to calculate operating income of 181,870. Okay, now that you have that set up, you can calculate your variances. So we'll start with the volume variances. And that's absolute value of 2 minus 3, right? The volume variances is telling us just based on the change in activity level. This is how much the variance overall for each line item is, just because the activity level that we plan for is different than the actual activity. It's basically that. So they are going to have you put in an amount for the difference between the cases, so the difference between the units. And you planned and you thought that you're going to sell 9,100 cases. You actually sold 9,500 cases. So did you sell more units than you were planning for?
Yeah, we
Yes.
sold.
Yes. So it's going to be favorable by 400 cases. So it's not a dollar variance, it's a unit variance. What does that mean? If my volume variance and is favorable, meaning that I am selling more units than I expected to sell, what do I expect for my revenue variance to be between the flexible budget and the master budget?
Favorable.
Favorable. So I can even do this right now. And for my variable expenses in the volume variance only, if I have a favorable revenue variance, and if I sold more units than I planned for, then my variable expenses all will have what variance?
Unfavorable.
Unfavorable, the opposite. If we sell more units than we were planning for, then we're going to have more expenses than we were planning for variable expenses. So to calculate the variance, we're just going to compare absolute value of the flexible budget column 2 minus 3. So positive numbers only. 247 was what our flexible budget is showing for revenue versus what we planned, 236,600. How much is the dollar amount?
10,400.
10,400 favorable. We achieved a higher volume of sales than we planned for. So the variance related to that change in variance is 10,400 favorable. Packaging expense. When we sell 9,500 cases, it's 9,500 versus what we planned to expense 9,100 in packaging expense. The dollar difference is 400, unfavorable. Shipping expense, 19,000 based on the actual output versus what we planned, 18,200. How much is the variance?
800.
800 unfavorable, higher than planned. For sales commissions, 12,350 compared to what we planned, 11,830. How much?
520.
Correct, 520, unfavorable. Take the time, figure out how much in unfavorables you have so that you can subtract it from the favorable revenue variance and figure out what the variance would be and then compare it to here too. So do both to check your work. So when I add up, and this is the variable expense variances, 400 unfavorable, 800 unfavorable, 520 unfavorable is how much?
1720.
1720 unfavorable. So that's just for the expenses. And I'm going to compare that to the favorable 10,400 favorable revenue variance. So revenue was 10,400 favorable, less the variable expense variance of 1720 unfavorable. Because we had a higher volume level than planned, our contribution margin is favorable or unfavorable? Did we have greater favorable or unfavorables?
Favorables.
Favorables. And this is an expense, so we're subtracting, netting it. 10,400 favorable minus 1720 unfavorable gives us a contribution margin variance of 8,680 favorable. And when you take 206,150 contribution for the flex versus 197,470 contribution margin for the master budget, what do you calculate?
680.
Yeah, 8,680 favorable. It should calculate the same. It's worth your time, especially in the performance report, to calculate both ways just to make sure that your calculations and all your numbers look right. Because you can catch errors that you've made this way. Fixed expenses for the volume variance is super easy. 0. All the fixed expenses will always be 0, which they consider in your textbook, in your homework, favorable. You don't have a variance because you're including the same numbers. It has nothing to do with activity level.
Well, it's within your relevant range, right?
Correct. Yes, it's within your relevant range. Thank you for bringing that up. And the problems on your test will be within the relevant range.
Okay,
If
cool.
they weren't within the relevant range, then yes, you would have a step up or you would have an additional cost. Thanks for mentioning that, Wade. For operating income, take the time, 195.50 minus 181.870. Does that equal 86.80 favorable?
Yes.
I mean,
Yep.
no.
That's what it should equal. Because the contribution margin difference is what the variance is.
Yeah.
Questions? How did you do on the calculating out the flexible budget and the master budget?
So if all there is a volume, at this point, if all there is a volume variance and we're within our relevant range, this is what we should see, right? Always. I mean, because.
Yeah.
Okay.
So if you have the opposite where your volume level is less than planned, then it would just be the reverse. You would have an unfavorable up here for your variance for the cases, and then an unfavorable for revenue, favorable for the variable expenses, but your contribution margin would also be an unfavorable. And it would trickle down to the operating income too. Is this pretty easy? Just setting it up takes a little bit of time.
Yeah.
Okay. The last one actually makes a difference. This is the flexible budget variances. And if you were a manager, this is what you're paying more attention to than the volume variances, because this is how telling us how well we did. So flexible budget variances. I'm going to use a different color. So we're going to compare two minus one.
I'll be consistent, sorry, 1 minus 2. It's flexible budget variances.
You sound awful.
Sorry. Sitting down that way. Those are going to give me biceps and letting this off. Holding it up.
Okay. So with this one, the actual quantity is the same as what you're using for the flexible budget, because flexible budget is based on actual output. So you're always going to have 0 quantity variance, right? Between the actual and flexible budget. For the flexible budget variances, I can't say that if one is favorable, the other is going to be unfavorable. It just depends on what actually happened. So we're saying, okay, here's what actually happened. It's not based on any formulas. This is reality, how much revenue we actually earned, how much in expenses we actually incurred during this year. It's column 1. Versus what we should have achieved based on the number of units that we sold in that flexible budget. So if our revenue is higher than our flexible budget, that's a good thing. That's favorable. But if our actual expenses are higher than what we should have achieved based on our standard, based on our flexible budget, then it's unfavorable. So actual revenue was 255,200 versus flexible budget revenue 247. We should have earned 247. We actually earned 255,200. What's the variance?
8,200.
8,200, and it's favorable. We earn more revenue than we should have when we sold 9,500 cases. So maybe we upsold some of our items, maybe we charged a higher price, right? For packaging expense, do you guys want to do these ones on your own?
Yeah.
Okay. Okay, for packaging expense, 10,600 was actually incurred versus 9,500, which was what was budgeted to be incurred or should have been incurred when you sold 9,500 cases. Favorable or unfavorable?
Favorable.
Unfavorable. You spent more than you should have on packaging expense, and how much more?
1100.
1100 unfavorable. So what do you think could have influenced that? It's not the number of units that they sold, but why would they maybe see a higher cost for packaging?
The price for packaging could be more expensive.
Yeah, the price per packaging could be more expensive, or maybe they are shipping it somewhere further, so they have to use different packaging material that has a higher cost. Or the individual could have requested different batches be sent to different locations, so they had to package it separately. That could be influencing that. For shipping expense, 19,500 versus 19,000, what you should have incurred. Favorable or unfavorable?
Unfavorable.
Unfavorable by 500. Again, it's probably due to either an increase in rate, or it could be related to multiple locations that they're sending it to versus one that you were assuming it was being sent to for each case ordered. Sales commissions, higher than we're expecting it to be. 12,350, or yeah, 12,350 is what was planned versus we actually paid out 12,760. And it has to do with the fact that we had a higher selling price per unit for some of those units that we sold. They charged them a higher price, so we had to pay a higher commission. It's going to be unfavorable by how much?
400.
Okay.
410.
Oh yeah, 14.
Yeah. For variable expenses, so I'm just going to, for the contribution margin variance, you had a total of how much in variable expense? It's an unfavorable variance of how much? $1,100 plus 500 plus 410, they're all unfavorable.
2010.
Yeah, 2010 for variable expense variances.
It's
And
a
you're-
6,190 favorable.
Yeah, so it's going to be favorable because you have more favorable variance for revenue, and it's 6,190, correct? And that is the difference when you're comparing 2,000 or 212, 340 versus 206, 150. For fixed expenses, you're doing the same thing. Salaries expense, 7,300 versus what you should have incurred, 6,500. Higher or lower than you should have spent?
Higher.
Higher. So $800
Favorable.
unfavorable, correct. You may have incurred some overtime or maybe training hours, so you had additional hours. Or it could have been related to that additional packaging expense, right? Something you would want to investigate. Office rent, any variance?
No.
No, so you're still going to put 0 favorable. Depreciation expense, no variance, 0 favorable. Insurance expense went down. You were expecting 1,800, but it was actually 1,600.
200 favorable.
200 favorable. So maybe they lost some employees. That's why their insurance expense went down. Maybe they just got a rate reduction, which is strange. For supplies expense, they used a lot more supplies than they were expecting.
700 unfavorable.
700 unfavorable. For the operating income expense, figure out the fixed expenses. So the fixed expenses, you have
1700.
so 800 plus 700 unfavorable, right? So 1,500 unfavorable. And then you have 200 in favorable variances for fixed expenses. So 1,300 unfavorable for fixed expenses is a variance. You're comparing that to your contribution margin variance, 6,190. Sorry, it's hot here. My brain is going away. 6,190 favorable versus fixed expense variance of 1,300 unfavorable. Favorable is greater. So your operating income variance becomes what?
4,890.
4,890 favorable, correct. Questions? Are you excited to have this one on the test for 25 points?
Overwhelming everything.
Yeah.
So it is an easier one. I know that. That's why I put it like that. And I give you kind of a good point value to it. But still practice, still double check your numbers. But you should be fine. We're going to take a break because I need it before we go over the last problem. So come back, let's say 10 minutes, come back at 1:52 and we'll go over that last problem. Okay, so this last problem is just calculating direct material and direct labor variances. 25 points, and then there's some similar problems down below. Some of those problems I think are just calculating, I think 28 and 29 are looking at direct materials and then direct labor in two separate problems, so based on the same information. Same with the 44 and 45 for those exercises. So it's similar, but just a little bit different in setup. Dazzle Fabrics manufactures a specialty monogrammed blanket. The following are the cost standards for the blanket. So direct materials, $2 yards per blanket at $7 per yard. So I am going to set up information for direct materials and direct labor because I think it is easier, especially when it's given to you all at once. 2 yards per blanket is what?
Material.
It's material, yeah. So it's going to be under the materials, but is it standard quantity, standard price
Actual price.
for two yards?
Quantity per unit.
Yeah, standard quantity per unit. So 2 yards. Let's do this. Sorry. 2 yards per unit.
The 1149A.
This is problem 1149A, correct? Yes. And then the $7 per yard is what?
Standard price.
Standard price. Yep. So standard price, $7 per yard. 0.5 direct labor hours per blanket at $19 per hour. What is the $19 per hour?
Direct labor.
Direct labor, which part?
Standard price.
Standard price, yeah, $19 per hour. So that's obviously per direct labor hour. And 0.5 direct labor hours per blanket.
Standard quantity.
Yep, standard quantity per unit. So 0.5 direct labor hours per unit. So these two things we've taken care of. Actual results from last month's production of 2,400 blankets are as follows. What's the 2,400 blankets?
The output.
The output.
Output, actual output. So the number of units produced. So 2,400 units. My dog hates FedEx and UPS when they come down the street. You can imagine how fun this quarantine period has been. Okay. Actual cost of 6,240 yards of direct materials fabric purchased was 40,560. So let's start with the 6,240 yards purchased.
You divide that by the 40 for the cost.
We will use that, yes. But what is that 6,240 first?
The actual cost.
Actual quantity.
Per year.
Actual quantity purchased.
Oh.
So 6,240 yards purchased. And then we have $40,560, which is the cost that we paid for those yards of fabric. So we're gonna do a little calculation for the actual price. That one's actually not my dog. Okay, so we're gonna take our 40,560 total cost for those yards divided by 6,240 yards purchased. To get what price per yard as our actual price paid per yard.
$6.50 per yard.
$6.50 per yard, correct.
Wait, do we round to the nearest 10 cents? Or
Let me see. In the test, the problem should tell you what to round it to, but I will confirm. 40,560 divided by 6,240. There's no rounding on this one. It's evenly divided to 650.
oh wait, yeah, I messed up the numbers.
No worries.
You did too.
For actual yards of direct material used, the 5,540, what is that?
The used portion of actual quantity.
Correct. So actual quantity used. So 5,540. 5,540 yards used. So we know that we're going to have two calculations over here
Right.
because the quantity used is different than the quantity purchased. That also tells you that you're not going to calculate a total direct materials variance because it's two different levels of input. For the last line of information given, actual wages for 1,350 direct labor hours worked was 24,840. So actual quantity for direct labor was 1,350 direct labor hours. And we're going to use that to calculate the per hour actual price. So they provided us with 24,840, which is our AQ times our AP for direct labor, divided by the quantity of hours, the actual quantity, 1,350 direct labor hours. So on a per hour basis, how much did we pay for direct labor?
1840.
Yes, $18.40 per hour. Okay. First question, what is the standard direct material cost for one blanket? So how do I figure that out? What is this technically asking? This is not from this. This first question is technically what you would see on the standard cost card. Okay. So what is the standard direct material cost for one blanket? You're going to take, actually, I'll move this
Yards
over.
times $7 a yard.
Correct. So I'll just put the answer for number one. So 2 yards per unit
14.
times $7 per yard in the standard cost. So this is the standard quantity, standard price to get $14 per unit. So when you multiply yards per unit times a dollar amount per yards, the yards is eliminated and you're left with a dollar amount per unit. For question 2, what is the actual cost per yard of fabric purchased? Did we already figure that out?
Yes.
Yes, we already figured that out. And the way that we figured that out was we took 40,560 actual price paid for those 6,240 yards purchased to calculate 650 per yard is the actual price paid. Now we get to get into the standards that they're requesting. So calculate the direct material price and quantity variances. So do you guys want to try this? Okay.
Yeah.
I'm gonna pause. Okay, so under 1 and the first half of 2, the actual yards is purchased. So actual yards purchased is going to be used, 6,240. And under 1, we're going to have that at the actual price. So how much you actually paid per yard for those yards that you purchased, 6,240 yards purchased. So you calculate out a total of 40,560, which was given. Sometimes when you calculate out that per yard amount, it's a rounded number. If they give you the total, always put the total here. For column number 2, it's the actual yards purchased at the standard price. So how much you should have paid per yard for those actual yards that you purchased. So $7 per yard is what you should have paid. times 6,240 yards purchased, and you calculate for the first number under number 2, how much?
43,680.
43,680. For the price variance, what are we focusing on? What's held constant?
The $7.
What's held constant so isn't changing?
How much we
The
paid?
yards purchased.
The quantity purchased. So the quantity purchased is 6,240 yards. That's held constant. What we're focusing in on is the price that we paid. So we should have paid $7 a yard. We actually paid $6.50 per yard. So did we pay more or less per yard than we should have? So this is what we actually paid. This is what we should have paid. Less. So it's going to be favorable. We like to pay less. It's an expense. And the dollar difference is
3,120.
120 favorable, correct. This test problem may want you not to show it in the table, but similar to what you had to do for your homework. So for part 3, you would put the standard price per unit, not per unit, but it says per unit. It's actually standard price per yard, by the way. Which was $7 per yard. You're comparing that to the actual price per yard of $6.50 per yard. And you calculate a difference of how much per yard? $7 versus $6.50?
50 cents.
50 cents per yard. Yeah. So I'm just showing you the variance for how you're gonna have to enter it in. Does everybody see where the $7 per yard came from? So remember, this is the formula that they're gonna ask you to use for that price variance. AQ comparing AP minus SP or vice versa. And you're gonna multiply that times the actual quantity purchased. 6,240 yards to get the direct materials price variance that we just calculated. 3,120 favorable. I'm only showing you this because that's the setup they're going to require you to use. But I would recommend doing this on the test, and I will accept you to send me your work. Okay, because I can see how this could get confusing when entering answers. So I will check it for you. Questions on that price variance? Okay. For the second part of part 2, you have to enter in the number of yards used. So you used 5,540 yards. And at the standard price, $7 per yard. So based on the usage, the actual quantity used, how much did you incur in direct material costs?
Oh,
38,780.
Correct. 38,780. For part 3, you're going to take your yards or your standard quantity per unit. So how many yards per unit?
2.
2 yards per unit times number of units produced.
2,400.
Yep, 2,400 units produced at the standard price of $7 per yard. So first things first, multiply those two numbers, 2 yards per unit times the number of units produced to figure out how many units you should have used. I'm sorry, how many yards you should have used. Mailman, sorry.
4,800.
4,800, correct, yards at the standard price of $7 per yard. So when you produce 2,400 units, how much should you have incurred in direct material costs?
33,600.
33,600. With the quantity variance, we're focusing in on
Used.
usage, right? So the yards used. So 4,800 yards is what we should have used versus 5,540 yards that were actually used. Did we use more than we should have?
Yeah.
Yes. And it's going to be
5,180.
5,180.
Unfavorable.
Favorable.
Unfavorable. You used more yards than you should have.
And that's just the end of that, since there's different quantity purchased and different quantity used, right?
Correct. And it's not asking you to do it either.
Okay.
But yes, that would be the end of that. And then for the calculation, you would do actual quantity used, and this is the total, so 5,540, 5,540 yards used compared to the standard quantity allowed. So 4,800 yards. And you subtract that to get the difference of 740 yards. And then you multiply that times the standard price per yard. $7 per yard. And you'll calculate that to be 5,180 unfavorable. And that's your direct materials quantity variance. And remember, this one is basically holding the standard price, subtracting AQ, actual quantity, minus the SQA, which is what we are doing. I think that when you're looking at the formulas, it gets quite confusing because if you look above, that's on it's on a per yard basis. Down here is the totals. So it can kind of just confuse you what you're supposed to enter. And it also is not having you really think about what's going on and kind of compare it. It's just basically doing calculation like you're in a math class, which you know you're not by this point. How did you do in the table portion?
Did pretty good.
Pretty good. The more you do these variance analysis, the easier those become, and then the easier those backing into ones will be for you. So always practice these ones first, where you're doing just the variance analysis before you're going to study for the backing into problems, the ones that we went over last class. Can I expand it away so you can't see that part? Is that okay?
Yeah, that's fine.
Okay, thanks. Okay. For part 4, what is the standard direct labor cost for one blanket. So it's having you do something similar to what you did for number 1. And you would take your standard quantity per unit, which is 0.5 direct labor hours per unit, times your standard price, which is $19 per direct labor hour. And you calculate what amount. $9.50 per unit in direct labor cost. For number 5, we had already calculated it. It's asking you what is the actual direct labor cost per hour. So it's the $24,840 in direct labor cost divided by 1,350 direct labor hours that were actually incurred. And we calculated $18.40 per direct labor hour. So this is question 6, calculate direct labor rate and efficiency variances. Do you guys want to do those ones on your own? Okay.
Professor, can I see number 3 again when you get a chance?
Yeah. Oh,
Thank
number 3 is up at the top. Oh, are you talking the one on the right side?
Yes, please.
Yeah. There you go. Okay, for actual quantity, how many hours did you have?
1,350.
Yeah, 1,350, correct. 1,350 direct labor hours, so I'm putting it under 1 and 2. So that's where we're using the actual quantity. And then for number 1, it's at the actual price, and the actual price paid per hour was $18.40 per direct labor hour. And you multiply that times the 1,350 direct labor hours, and it recomputes to what was given. 24,840 was the total cost for direct labor. For part 2, it's actual quantity, actual number of direct labor hours used at the standard price, how much you should have paid per hour. $19 per direct labor hour. So how much should you have paid for those 1,350 direct labor hours?
25,650.
25,650. So for direct labor, the rate variance, we're focusing in on the rate, right?
Mm-hmm.
We should have paid $19 per direct labor hour. We actually paid $18.40. So we paid less per hour.
With a favorable amount of 810.
Correct. It's going to be a favorable price variance or rate variance of 810. And for what they're going to ask you to write out to answer this one, they flipped it on you. If you looked above, they started with the standard price per yard, but this time they're starting with the actual rate per hour. So I don't know if you put it the opposite if they'll mark you wrong, but just so you know, that's what they're putting first. So actual rate per hour is $18.40 per hour. And then you're comparing that to the standard rate, how much you should have paid per hour, which is $19 per hour. To get the difference, which is 60 cents per hour. And then we're multiplying that times what we're holding constant, the actual quantity. So the actual quantity, or the actual hours used. And that was 1,350 direct labor hours. So remember, it's AQ, or actual quantity incurred for hours, actual hours. Write it. Compared to actual rate minus the standard rate. SP minus SP minus AP. And then that gives you your direct labor price variance or rate variance. $0.60 per hour times 1,350 direct labor hours, 810 favorable because you're incurring a lower rate per hour. Okay. Does this part make sense over here? And where the numbers came from?
Yeah.
For the last column, column 3, standard quantity. So how many direct labor hours per unit are we supposed to use?
0.5.
Yeah, 0.5 direct labor hours per unit. And we multiply that times the number of units produced, which was 2,400 units, to get our standard quantity allowed, which is
1,200.
yeah, 1,200 direct labor hours at a standard price of $19 per hour. So you should have paid how much for direct labor when you created 2,400 units?
22,800.
22,800. With the efficiency variance, we're focusing in on quantities, right? We should have used 1,200 direct labor hours. We actually used 1,350.
Mm-hmm.
So we used more hours than we should have. So our efficiency variance is going to be
Unfavorable.
unfavorable. By how much?
2,850.
2,850 unfavorable. So if I was to do the total variance for direct labor, it's going to be unfavorable. It's not asking you to do that, but it would be 2,040 unfavorable. For what you need to include for this calculation, start with your actual hours. And this is the total hours. So 1,350 direct labor hours. And you're comparing that to the standard quantity allowed. 1,200 hours. To calculate the difference between the actual and the standard, 150 direct labor hours. And then you're going to multiply that times the standard price per hour. $19 per direct labor hour. To back into the same answer that we came up with, 2,850 as your efficiency variance. Unfavorable. So this one, we're holding the standard price constant, $19 per hour, and we're focusing in on the difference between the actual quantity compared to the standard quantity allowed. The last two questions are theory questions. So analyze each variance and speculate as to what may have caused the variance. If you're looking at direct materials, you had a favorable price variance and an unfavorable quantity variance. What happened?
Materials is cheaper and end up using more.
Yeah, the materials were not the right quality. It was an inferior quality product, and you used more because of this, which caused you to have a higher quantity variance and a lower price variance. For direct labor, what happened?
Cheaper labor that took more time.
Yeah, cheaper laborers than you were expecting to use. So maybe you were training some employees, or newer employees, or lower level staff were being trained in this. And they took more time, which is expected. For 8, look at all 4 variances together, the big picture. How might they all be related? What variance is very likely to have been caused or to have caused the other variances?
The inferior materials.
Yeah. So the inferior materials could have very much caused the others to be unfavorable. The other one could also be the newer staff, right?
Professor,
Yes.
on the test, would we have a question like that, and how would we go about answering? Like type it in, or?
Yeah, I think it's the drop down typing it in.
Oh, okay, gotcha.
Yeah. That's what I think it is. I'm not positive. I'd have to verify for you, but you will have these questions on the test.
I think it's a drop down.
Yeah, I'm pretty positive it's drop down.
Which problem did you say was 25 points?
This one is 25 points, and the one we just previously did. Flexible budget performance analysis.
Okay, cool. Thank you.
Okay, I'm going to turn off the recording.